we see more gains ahead. We think that the news that we've seen out of Pfizer is not what you've been seeing in the last year. Things like the Russian vaccine, various cocktails and all these sorts of things. We're going to see a different world economy over the course of 2021, particularly as we get more vaccines that have good logistics and an ability to truly end the pandemic. And if you combine that with all the money on the sidelines, with negative real yields, zero yield cash nominal, these sorts of things, again, can get a lot of money in risk assets. I think it will also be a rotation, in fact, into the particular stocks, the industries that have been most beaten down. It can create, I think, a little bit of headwind for those that have been in a COVID boom. And that, of course, being what we're using right now, various video conferencing, all of these things.
Yeah, exactly. And I look forward to seeing you back on set someday soon, Stephen. I mean, listen, it is tough. The numbers are tough. The cases are tough. Thankfully, outcomes, for the most part, have gotten a lot better. Europe, many European nations are being hit harder than we are right now. It's very tough in Belgium and Italy and Austria closing their schools today as well. But we will get out of this. How much do we need to focus on these short-term headlines, Stephen? Because they are pretty grim versus looking forward to the spring and the summer when we're going to be vaccinated, the pandemic will have likely run its course, and we can hopefully get back to a more normal track.
Equities trade on what's going to happen shortly ahead. They're not a long leading indicator. I think everyone is not going to act just on faith that we're going to be out of this. Setbacks like we had yesterday will be here with us until we see that material change. I do think that in the United States, now that we're sustainably above 100,000 new cases per day, we're going to face more headwinds here, not just in Europe. I would say, though, that what we're looking at the data, we are seeing less of a decline in economic activity associated with higher caseloads. This is really useful data in Europe, where there's been this big divergence across different countries. The massive amounts of differences in COVID, for example, in France versus Germany, has not resulted in a markedly different economy. I'd also note that what's being called shutdowns, these things are very different from what we saw in the initial shock phase in March and April. Back in April, we had a 98% decline in U.S. auto production in the United States. We didn't do that during the Great Depression or World War II. Even socially distant activity was shut down. So I think this is going to be different. It'll restrain the upturn. It's going to be a hard few months, but there is light at the end of the tunnel.
Yeah, important points to note. This is very different from March and April. We know a lot more, obviously. Neither you or I are doctors, but I mean, the politicians have said this. I mean, these lockdowns that are coming are not going to be like they were before. They're going to be shorter, more targeted. It's not going to be that total sort of, 2 months of just literally afraid to leave the home like we had in this area.
Exactly.
Besides the coronavirus, which will eventually, be in history, hopefully sooner than later, by the way. What are some of the macro headwinds over the next year or two? Is it still strained relationships with China? Is it the federal debt, the federal deficit? What are you concerned about, Stephen?
Look, we think a Biden administration is going to be less in the headlines when it comes to international relations. They've got to build an administration. Trade policy is going to form over time. The approach to China is going to be put off for a while, gathering some coalition members to deal with this particular issue. So this is going to be an environment where international trade is already recovering because of some shifts in consumption that we've seen around COVID, but it's likely to recover a lot more. And so that's not going to be the worry that it was. I think that if you look at the near term, the fact that we have had so much of a rebound from this shutdown period. We've added 3 million restaurant jobs, for example, that this can be harder to achieve greater gains over the winter months. The fact that we are coming off of a second major economic collapse over the last 12, 13 years, we have a federal debt burden that's over 100% of GDP. We had one of those in World War II as well. By 1975, that federal debt burden was cut down to 25% of GDP, but it was achieved with financial repression. It was achieved by purposely keeping real interest rates low. So one of the problems here for investors is going to be that they will not get a return on cash or a real return on safe haven bonds. If you take a look at the period after World War II was practically 4 decades before you made an incremental dollar in real terms in bonds and cash. So I don't want to go and say that this has no portfolio value. There's great diversification benefits as we have from longer duration safe haven bonds at some level. But we have to take a look at different portfolios. We have to take a look at the fact that global dividend yields are twice global bond yields now. And there are different regions of the world that outside of China and the United States, stock markets haven't performed that well.
Shepard Smith here. Thanks for watching CNBC on YouTube.